Preparing for a finance roles at MyState Bank interview? You've reached Candy Mentor, and this video is for you. We'll walk through 20 key questions you're likely to face. For each question you'll see a sample answer followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. Why do you want to work in a finance role at MyState Bank? I want a finance role at MyState Bank because banking finance connects technical analysis with real customer and business outcomes. I am attracted to a customer-owned institution where disciplined capital allocation and responsible lending matter alongside profitability. My strengths in financial analysis, reconciliations, and communicating insights would help management make better decisions. I also value the opportunity to understand banking economics, particularly funding costs, credit risk, margins, and regulatory requirements, while contributing to a practical, collaborative team. While answering, connect your motivation to banking, financial discipline, customer-owned values, MyState Bank's regional presence, and the opportunity to support lending, risk management, performance reporting, and sustainable growth. Question 2. What are the main financial drivers of a bank's profitability? A bank's profitability is primarily driven by net interest income, fee income, credit losses, operating expenses, and capital efficiency. Net interest income depends on loan yields, funding costs, and the mix of assets and liabilities. Growth can increase revenue but also consume capital and raise credit risk. I would therefore assess profitability through margin, cost-to-income performance, impairment trends, return on equity, and sustainable balance sheet growth, not through revenue alone. Make sure to cover net interest income, non-interest income, credit losses, operating expenses, funding costs, balance sheet growth, capital requirements, and how these drivers interact rather than operating independently. Question 3. Explain how the three financial statements connect in a bank. The income statement records interest income, funding expense, fees, operating costs, and impairment, producing net profit. That profit increases retained earnings within equity, while provisions reduce loan carrying values or create allowances. New lending increases assets and usually requires funding through deposits, borrowings, or capital. The cash flow statement reconciles these movements, although bank cash flows are heavily influenced by balance sheet changes. I would always analyze all three statements together. In your answer, explain income statement earnings, balance sheet movements, cash flow implications, retained earnings, provisions, loan growth, and why bank cash flow analysis differs from analysis of a typical industrial company. Question 4. What is net interest margin, and what causes it to change? Net interest margin measures net interest income as a percentage of average interest earning assets. It rises when loan yields increase faster than deposit or wholesale funding costs, and falls when funding reprices more quickly than assets. Margin is also affected by competition, fixed-rate lending, interest rate hedging, product mix, and liquidity costs. In an interview, I would distinguish reported margin movement from underlying margin, separating one-off effects from sustainable pricing or funding changes. Be sure to mention net interest income divided by average interest earning assets, loan pricing, deposit and wholesale funding costs, asset mix, repricing timing, hedging, competition, and changes in interest rates. Question 5. How would rising interest rates affect MyState Bank's financial performance? Rising rates can initially support margins if loan yields reprice faster than funding costs, but the result depends on deposit competition and repricing timing. Borrowers may face higher repayments, increasing arrears and expected credit losses. Fixed-rate assets may respond more slowly, while wholesale funding costs can rise quickly. I would assess margin, customer behavior, liquidity, capital, and impairment under multiple scenarios rather than assuming higher rates automatically improve profitability. Discuss asset and liability repricing, variable and fixed-rate loans, deposit beta, funding costs, arrears, borrower affordability, net interest margin, liquidity, fair values, and the importance of scenario analysis. Question 6. How would you assess a borrower's credit risk? I would start with sustainable repayment capacity, reviewing verified income, expenses, existing debt, and sensitivity to higher interest rates. Then I would assess loan-to-value ratio, collateral quality, credit history, employment stability, and any relevant industry or geographic risks. I would challenge assumptions, confirm documentation, and consider whether the borrower remains viable under stress. Collateral provides protection, but the primary repayment source should be dependable cash flow. Focus on repayment capacity, income stability, debt service metrics, collateral, loan-to-value ratio, credit history, industry or employment risks, documentation quality, and how qualitative factors supplement numerical analysis. Question 7. What is International Financial Reporting Standards 9 expected credit loss, and why is it important? International Financial Reporting Standards 9 expected credit loss is a forward-looking estimate of credit losses, rather than a provision recognized only after default evidence appears. Performing exposures generally use 12-month expected loss, while assets with significant credit deterioration or default require lifetime loss estimates. The calculation incorporates probability of default, loss given default, exposure at default, macroeconomic scenarios, and sometimes management overlays. It matters because assumptions can materially affect earnings, reserves, and capital. Make sure to cover forward-looking expected losses, probability-weighted scenarios, staging, lifetime versus 12-month ECL, probability of default, loss given default, exposure at default, and management overlays. Question 8. What is the difference between a loan impairment provision and an actual write-off? An impairment provision is an accounting estimate of expected or identified credit losses, recorded through the income statement and an allowance account. A write-off removes a loan balance when recovery is no longer reasonably expected, although collection activity may continue. Provisions can therefore rise before any write-off occurs, especially when economic conditions deteriorate. Recoveries may later reduce losses. I would reconcile opening allowances, new provisions, write-offs, recoveries, and closing balances. In your answer, distinguish an accounting estimate from removing an unrecoverable asset, explain allowance movements, recoveries, profit impact, and why provisions can occur before realized losses. Question 9. How would you explain liquidity risk in a bank? Liquidity risk is the risk that a bank cannot meet payment obligations when due without unacceptable cost or loss. I would monitor deposit stability, wholesale funding maturity, liquid asset buffers, cash flow gaps, collateral availability, and concentration risk. Stress tests should consider rapid withdrawals and market funding disruption, supported by a contingency funding plan. This differs from solvency risk. A bank can be solvent overall yet face immediate liquidity pressure. Discuss the ability to meet obligations when due, deposit outflows, wholesale funding, liquid assets, maturity mismatches, contingency funding plans, stress testing, and the distinction between liquidity risk and solvency risk. Question 10. What does asset-liability management involve? Asset-liability management coordinates the bank's assets, liabilities, and capital so earnings and risk remain within approved limits. Key areas include repricing mismatches, duration, fixed versus variable lending, deposit behavior, funding maturity, liquidity buffers, and hedging. For example, a bank funding long-term fixed-rate loans with short-term liabilities may face margin and refinancing risk. Decisions should balance near-term profitability with resilience under stressed interest rates and funding conditions. Be sure to mention managing interest rate risk, liquidity, funding composition, repricing gaps, duration, deposit behavior, hedging, balance sheet strategy, and balancing earnings objectives with resilience. Question 11. How would you investigate an unfavorable budget variance? I would first confirm the variance is genuine by reconciling actual results to the general ledger and reporting definitions. Then I would separate volume, price, mix, timing, foreign exchange, and one-off effects. I would speak with the responsible business owner, test the explanation against operational data, and assess whether the issue affects the forecast. Finally, I would recommend an action, such as repricing, cost control, or revised assumptions, and track resolution. Focus on defining the variance, separating volume, price, mix, timing, and one-off effects, validating source data, identifying accountability, quantifying the outlook, and recommending practical corrective action. Question 12. What financial controls are important in a bank finance team? Important controls include daily or monthly reconciliations, segregation of duties, controlled journal preparation and approval, restricted system access, independent review, and documented balance sheet substantiation. I would also expect data quality checks, clear reporting ownership, exception escalation, and evidence retained for audit and regulatory review. Strong controls should prevent errors where possible and detect them quickly when prevention fails. I see control quality as part of reliable decision-making, not merely a compliance requirement. Mention reconciliations, segregation of duties, journal approval, access controls, data lineage, independent review, balance substantiation, regulatory reporting checks, exception management, and evidence that supports auditability. Question 13. Tell me about a time you found an error in financial reporting. In a monthly reporting process, I noticed an expense variance that did not align with the underlying invoice schedule. I traced the difference to a duplicate accrual created during a system interface issue, confirmed it with supporting documentation, and escalated it before reporting was finalized. I corrected the entry, documented the root cause, and added a duplicate check step to the reconciliation. The experience reinforced the importance of investigating unusual movements rather than accepting automated outputs. Use a concise star. Question 14. How would you use Excel or data tools in a finance role? I use Excel to structure data, reconcile balances, analyze variances, and build transparent scenarios. I am comfortable with pivot tables, XLOOKUP, SUMIFs, logical checks, and sensitivity tables, while keeping inputs, calculations, and outputs clearly separated. For recurring work, I look for controlled automation through Power Query or approved reporting tools. I always validate totals against source systems and include reasonableness checks, because a sophisticated model can still produce an incorrect answer. Discuss data cleansing, pivot tables, XLOOKUP or equivalent functions, reconciliations, scenario models, checks, automation, version control, and validating outputs against source systems before presenting conclusions. Question 15. How would you measure the profitability of a home loan product? I would evaluate the loan's expected lifetime contribution, not just its initial interest spread. That means estimating customer pricing, funding and hedging costs, fees, operating expenses, prepayments, expected credit losses, and the capital required for the exposure. I would then calculate a risk-adjusted return and test sensitivity to rates, arrears, and early repayment. A product can have attractive headline pricing but weak economics after funding, servicing, risk, and capital costs. Cover interest income, funding and hedging costs, fees, expected credit losses, operating expenses, capital allocation, customer behavior, prepayments, risk-adjusted return, and profitability over the product's full life. Question 16. What is regulatory capital, and why does it matter to a bank? Regulatory capital is loss-absorbing funding that protects depositors and supports confidence in the banking system. Capital ratios compare eligible capital, especially common equity, with risk-weighted assets. Higher risk lending generally consumes more capital, so growth must be assessed alongside capital generation and required buffers. Capital matters because insufficient levels can restrict lending, increase funding costs, and trigger supervisory action. Strong capital improves resilience but also influences return on equity. Explain capital as loss-absorbing capacity, risk-weighted assets, common equity, capital buffers, growth constraints, regulatory confidence, and the trade-off between resilience, lending capacity, and shareholder returns. Question 17. How would you analyze an increase in arrears or non-performing loans? I would segment the movement by product, origination vintage, geography, borrower type, delinquency bucket, and loan-to-value ratio. I would examine cure rates, roll rates, unemployment or cost of living factors, collateral values, and collection performance. Then I would assess implications for expected credit loss, capital, pricing, and underwriting standards. The key is distinguishing a short-term timing issue from structural deterioration, using both portfolio data and operational feedback. Be sure to assess trend, vintage, product, geography, borrower segment, delinquency buckets, cure rates, collateral, macroeconomic drivers, provisioning impact, and whether the movement is temporary or structural. Question 18. Describe a time you had to explain complex financial information to a non-finance stakeholder. I once explained a forecast shortfall to an operational manager who did not work with financial models. I avoided technical terminology, used a simple bridge showing volume, price, and cost effects, and focused on which drivers the team could influence. I checked understanding through questions and agreed on 2 corrective actions. The conversation improved the forecast and strengthened ownership. My approach is to preserve analytical accuracy while presenting the decision-relevant message clearly. Highlight audience awareness, plain language, materiality, visual presentation, business implications, confirmation of understanding, and how you converted analysis into a clear decision or action. Question 19. How would you respond if a senior stakeholder asked you to change a number without support? I would ask what evidence supports the requested change and explain the impact of reporting an unsupported figure. If a legitimate adjustment exists, I would ensure it is documented, approved, and reflected consistently in the underlying records. If the request appeared misleading, I would respectfully challenge it and escalate through the appropriate finance or risk channel. Accurate reporting protects management, customers, auditors, and the bank, so pressure should never override evidence and governance. Discuss professional skepticism, evidence, reporting integrity, respectful challenge, escalation, documentation, materiality, approved adjustments, and the importance of protecting customers, management, auditors, and the institution. Question 20. What would you prioritize in your first 90 days in a MyState Bank finance role? In my first 90 days, I would learn MyState Bank's products, systems, reporting calendar, finance policies, and key risk measures. I would meet stakeholders across finance, lending, treasury, risk, and operations to understand how information flows and where decisions are made. I would prioritize accurate delivery, reconciliations, and control discipline before proposing changes. Once I understand the process, I would identify practical improvements that reduce manual effort or improve insight without compromising governance. Mention learning products and systems, understanding reporting calendars and controls, meeting stakeholders, reviewing key performance drivers, delivering reliable early work, and identifying improvements without changing processes prematurely. If you are still with us, congratulations! You are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.